Hi, and welcome to the Stockscores Market Minutes for April 1st, 2013. This week's topic, trade better with time frame analysis. I'll show you how to do that in just a moment. But a reminder that we're less than a week away from the Stockscores Canadian Active Trader Expo series starting up in cities across Canada. At these events, I'm going to show you how to make more money in the market, not only by finding the right stocks. I'll show you the telltale signal that most market-beating stocks provide, but I'm also going to show you how to size your positions and manage risk effectively. Now, all of these things are taught in these Active Trader Expos for free, but you do have to register, and you can register at stockscores.com/skate, the address that you see there on screen. Now, I'm going to be in Calgary this coming Saturday, April 6th, and then again on Tuesday, the 9th, Edmonton, Monday, April 8th, Vancouver, April 13th and 16th. That's a Saturday and then a Tuesday. Victoria, the Monday, April 15th. Toronto, May 11th, and Montreal, May 12th. And those Toronto and Montreal dates are both Saturday events starting at 9 in the morning. The weeknight events always start at 7 p.m. All right, let's get into this week's analysis. I want to talk about time frame analysis, and this is really the practice of looking at different charts of the same stock. So we might look at an intraday and a weekly chart and an intraday and a daily chart. But ultimately, you can do better analysis if you consider what is happening in the short term and the longer term chart. You know, if you're a longer term trader, you're probably trading off the daily or the weekly chart, but you can time your entry a little better by looking at the intraday to see whether the buyers or sellers are in control at that moment. By the same token, if you're a day trader and you're always looking at intraday charts, it really makes sense to also look at the daily chart to see who is in control of the market and whether there is some longer term support or resistance that is going to help your trade. I never take a trade without looking at multiple time frames. Doing so, and you'll get better at seeing the turning points in the market and the opportunity that they create. Well, let's go through our regular charts that we look at each week, and we'll do this on multiple time frames. Now, the first chart that I have on screen is of the S&P 500, and it's no secret that we've been in a nice upward trend for the last 4 months, and really, we've been in an upward trend on this market since 2009, so we're now coming into our 5th year as we go into 2014. But what's important here is that this trend is getting a little bit stuck at resistance. You can see we hit that peak early in March and we fell back, and we're hitting it again and having a little bit of trouble getting through that price peak from early in March. And that coincides with the all-time highs that the S&P has hit back in 2007 and in 2000. So we want to be a little bit cautious, but let's now go to the intraday chart, and we can see that there is still optimism building. Now I can say that because I can see here that the bottoms are rising from left to right over the last 5 or 6 days. So we've got optimism in that regard. We are stuck at resistance at about 156.75 on the SPY ETF. But the fact that there's rising bottoms on there as this market trends sideways tells me that the buyers are still in control of the market and they want to push it higher. I'm a little bit concerned about the risk up here simply because the market has done quite well in the last few months and it's hitting that long-term resistance, but we still don't have a signal that the market is breaking down, and therefore we must remain bullish. The TSX 60 ETF T.XIU is our next chart, and here you can see the daily, which shows a long-term upward trend, but for the last 2.5 months or so, this market really hasn't gone anywhere. And if we go to the intraday chart, you can see that over the last couple of weeks, we've seen some selling pressure, some profit taking in some of the stronger sectors while the weak sectors continue to languish. So in the TSX, you've got banking and financials pulling back. I think they're likely to bounce soon. You've got the miners and the materials continuing to look pretty awful. And so I want to be pretty careful with the TSX and only take the very best of trades that come along. There's a real lack of excitement, lack of liquidity in the TSX, and it's only the blue chip stocks on the Toronto Stock Exchange that are doing well right now. Here's the 20-year bond ETF. This is an important one because it's where people tend to hide their money. Now, in the last few days, we've seen this ETF actually break its downward trend line. Now, that's important because it could be that money is moving out of the stock market and back into the safety of bonds. I actually think that it's not quite that way. I think money is moving out of global stock markets, the emerging markets, the European markets, the Asian markets aren't looking all that great in general, although Japan looks good. Believe it or not, Sweden looks good. Australia looks good. But for the most part, most markets globally aren't doing all that well simply because their economies are not doing all that well. And I wonder if money is not moving into the US bond market, the treasuries, simply to escape those foreign markets and take advantage of a strong US dollar. Well, that's a big question mark, but when we go to the shorter term chart of the TLT, we can see some pretty good buyer support over the last 2 weeks. And it's interesting that that coincides with weakness in the Canadian market. And I think a lot of that has to do with the strong Canadian dollar, which is hurting commodity prices, which hurts the desirability for a lot of investors to get back into those inflation-based stocks. And I think that's likely because the global economy is just not doing all that well. US market is doing the best, and the US dollar is doing well also, and I think that's contributing to the strength of the US Treasuries. All right, gold remains in a downward trend. It hasn't really sunk a whole lot in the last 6 weeks. It's been going sideways in that time, and quite reasonable that it would do so because that sharp sell-off in February really took the market far below its downward trend line. It seems to me that this market is just winding its way back to that downward trend line. It could go sideways for a couple of weeks and hit it. It could go up in 3 days and hit it. But either way, the pessimism in this market still exists in the long term. Now, in the very short term, we've got some short-term falling tops, and so that tells me that after a little bit of a run early in March, the gold market is getting soft again, and I continue to want to avoid this market. Until the chart gets better, I recommend staying away from precious metals. Well, here's a short-term chart of the oil market, and I've brought up the short-term chart in a moment, or you'll understand why in a moment, because the oil market on this time frame, which is the last 30 days, looks pretty strong. We've had nice upward trending market, and overall the buyers are in control. When you go to the daily chart, you can see that strength in March, but you can also see that we're now coming up to resistance at the top of this pennant pattern, and that is a bit of a concern. It tells me that the strength in oil is probably going to fizzle out in the short term, and we may see this reverse again. Now, there's always the chance that we'll break that resistance line, which I've drawn in red, but it's not the likely thing to happen, and so you want to be pretty careful here with oil, and obviously the oil stocks will move based on oil. I think we could see some profit taking in oil soon, and I recommend a little bit of caution, but at the same time, this remains a neutral chart overall because we are in that neutral pennant pattern. All right, the fear index, the VIX, as you can see, in a long-term downward trend, really testing support. There's no fear. In fact, in this market, I would say it's overly complacent, which is a bit dangerous. That may create an opportunity for a reversal in stocks and a bounce back in the fear index, the VXX, but for now, this is something you want to avoid. It continues to form falling tops, whether you're on the daily interval, which was the last chart I showed, or on this intraday interval, where again, those tops are falling towards support. So until that cycle is broken, until we get a break higher from a rising bottom with some good volume to show enthusiasm, I think we want to stay clear of the VIX. All right, so I remain bullish on US stocks, but with an ounce of caution. We are coming into earnings season right now, and I think the market's going to look to see if earnings are really supportive of the fact that the US stock market has done so well. Canadian stocks, I'm neutral. It's stuck under resistance, short term, some selling pressure, although I do think that the banks are due for a little bit of a bounce back in the short term. Gold, I remain bearish. Oil, I remain neutral. All of these things can change in a very short time, but for now, this is my outlook. The markets are quiet ahead of earnings season, which begins in a week with the announcement of earnings by Alcoa, which is after the market close on April 8th. The U.S. markets continue to be the top performer, while commodity-based sectors are generally the weakest. Trade very selectively right now. Hold the large cap blue chips if you own them, but have an eye on the exit door, because if their earnings start to fall short, as I said, that starts next week, then we could see something of a correction as the market takes profits. Well, that has been the Stockscores Market Minutes for April 1st, 2013. Have a great week in the market and trade well.